Hey everyone, welcome back. So we just finished up part one. If you didn't catch that and you want to learn a little bit more about Disney, we just kind of walk through the slide I threw together. Some information we'll use as we build our DCF. So we'll go ahead and hop over to the DCF first. Just kind of baseline everyone. We have our income statement, balance sheet, and then I actually do pull in, and sorry, I can zoom in here and make this a little bit bigger. I pull in just a few items off the statement of cash flows. No reason to copy over the full thing when pulling out a DCF. Really, you just want DNA, PP&E, potentially stock-based comp if it's significant as we build out our DCF model. We'll see right now everything's roughing out, so we'll get that all corrected here in a minute. This actually should link up, and that should get rid of all the reference errors. Where do we have our growth rates? Here we go, right there. Oops, that's 2021. And that'll fix that, but I'll show you guys quickly just where I pulled this data. And for Disney, this was the first time I've ran into this. If you go to sec.gov, Disney actually doesn't have all their info on here, which is super strange. I've never seen this before. I didn't look into it. My guess is they probably changed ticker symbols or something, and that's why not all of it's coming through, or maybe it was just being weird. So when you search for 10K, only two of them pull up, 2019 and 2020. So I thought that was pretty strange. I've never kind of experienced that before. And I was like, what the heck? I can only get two 10Ks out of here. And you can see if we go back, right, there's only 3 pages of data. Um, so my guess is S4 registration of business combination. What happened here is when they combined with 20th Century or something, they had to re-register under a new ticker. But to get around this, what you can do, if it's not showing up on there, type in investor relations Disney, go to their investor relations website, and every public company will have a site like this. And then in some form or fashion, they'll give you what you're looking for. So here it's under reports and then annual reports. You can see they have all their annual reports listed and quarterly earnings reports. So super easy to still get. So we pulled all the data out of their 2020 10K here. So enough with that. What we're going to do first is just kind of baseline ourselves on their income statement. We'll see, right, revenue had grown from 52 billion to about 70 billion in 2019. Then due to the pandemic, dropped down a little bit. Gross profit 24 billion to actually down here, but 27 billion in 2019, which is promising. SG&A has just slowly been kind of growing along, but and this isn't super exciting. This is how they break it out in the financial statements section, but they do in the MD&A provide more transparency and actually quite a lot, which I thought was very nice. So for revenue, they actually break it down by segment. They have media networks, park and experience, student entertainment, direct to consumer, and eliminations. If you go back to the 2018, they actually don't provide the direct to consumer. So this actually came from the 2019 10K. They provided this view. So we don't have it for historical, but I think the reason why I wanted to look at it this way is the direct to consumer is going to be the growth driver for Disney going forward. And we can see, right, it went from 3 billion, 9 billion, 17 billion. So it's growing like crazy, which is good. And then here's just some revenue growth. But what we really want to kind of hone in here, and I guess I'll point it out real quick. I was actually really impressed with this. Disney provides quite a bit of information for each business segment. It's like direct to consumer here. They'll provide basically the full income statement for it, right? Here's the revenues, here's how they're broken out, here's total revenues, operating expenses, SG&A, D&A, all related to direct to consumer. And they do this for each of their divisions. So here's studio entertainment. So you could take my model and you could break it out even further and you could do it for each kind of subdivision. It seems a little overkill for the purpose of this video, but just so you're aware that information is there. So the first thing we're going to need to get around is the growth of the direct-to-consumer business. So this is their streaming services. And let me zoom out just a little bit here. Um, but here's their most recent press release. So they haven't fully released 2021 numbers, but in their Q1 release, they listed these numbers. And then Disney Plus in March, they announced they hit 100 million. So these are our proxy 21 numbers. And then they also released in December that by 2024, they expect to have 350 million subscribers. And then I've just spread this as a proportionate of their current subscribers to get those numbers. And then they also provide us the average monthly revenue per subscriber. So this is huge and pretty crazy. So Disney Plus, right, is only making $4 a month in revenue. Hulu, regular Hulu, is making $13.51. Hulu plus live sports and live TV, $75. And then ESPN Plus, $4.50. And then they've announced Star I don't think they've launched it yet, but they've announced that they will be launching a star streaming. I'm not super familiar with what that is. So I've included it on here, but I'm probably not going to bake in too many projections for it. So the big thing here is we need to understand subscribers going out through, 2030, and then their revenue per subscriber. And from there, that'll get us our total revenue number for the direct to consumer space. So the first thing we can look at, and we'll actually, I'll throw this in here real quick. We're just going to do paid subscription growth. We'll calculate how fast the subscribers have been growing, and then from there, hopefully we can make some educated projections going out. Makes sense. Okay. So here we can kind of see how things have been growing. Um, what is this calculating off of? Oh, okay. No, I don't want that. Okay, there we go. So now we can kind of see how the growth has been going. So we're actually seeing Hulu decrease, which is unfortunate, but because it is such a high revenue driver, but kind of makes sense. ESPN, so I guess we'll just start with ESPN. We're just going to assume they can kind of keep growing at this pace. We're going to say ESPN is going to keep adding, kind of more value to subscribers through sports and whatnot, and maybe eventually, we'll give them credit for adding some live sports or something like that. I think you can watch like some stuff now on there, but actually, I guess we should calculate what's that growth. So, based off the 350, if we evenly spread it, obviously they need to have higher than 17% growth. So maybe what we'll do is we'll plug Disney Plus actually. I think that's a better way to do it. We're going to plug Disney Plus in there at the end to get us back to 350 because I think that's going to be the main driver of their growth. So we'll go about it that approach. Let me just quickly do that. Hulu, right? So there's Hulu plus Live TV and then Hulu SVOD. Unfortunately, they've been declining. I mean, they grew in 19, right? Pretty significantly, but then declining. So I think, you know, maybe we just assume like a slow growth for them. I think that that's probably fair, that they can just slowly grow. Because it's already a pretty big base, but I don't want to assume this high impact dollar piece is going to be the big growth here. And the same thing with this. I mean, they had huge growth. You might be able to get big growth here, but for now, in our first base case, right, let's just hold it at 2%. And obviously, feel free to download this model after. I post them all there's a link in the bottom of the video. Feel free to download and just change these assumptions if you think I'm crazy. And then I guess total Hulu doesn't really matter. That'll just be the sum. But let's just do this. Give us like a nice slow growth, right? I mean, nothing crazy. Um, and I think this is really the big assumption we have to figure out is how this all is gonna grow for them. So now the plug here is going to be right the 350 minus the sum of this stuff. So 288 million. Probably reasonable, but to get there right, I mean, we're probably going to have to assume pretty significant growth. Probably 50% growth a year to get to something similar to that. So let's see. Yeah, that probably gets you pretty close. And then if we calculate the growth rate here, right, should be something pretty significant as well. So that's 20. Okay, so yeah, we could probably actually let's try to like even the stuff out. Um, let's go 36, 36, 40, 40. Maybe that's more realistic. I don't know. Just trying to get it kind of like, we could have calculated a CAGR, but that's fine. 42, 42, 43. Um, and then there we go. You get revenue numbers here based off. And so for this, I think I just did an average of the prior years. So if we kind of stick with that in our first base case assumption, here we'll just paste this across. Oops, what the heck is going on? There we go. This will get us our revenue numbers. And then we still have to project out future years as well here. So, I don't think they're going to be able to continue this growth forever. I think there's kind of this like core mass. Once you get them signed up, your growth is going to start to drop significantly. Um, I don't know if you can really get 1 billion people onto this platform, but um, we'll stick with this for now and see what we get here as far as, oops, what is that? Oh, there we go. I mean, yeah, this ends up with 1 billion people. That's way too many. We're not going to get 1 billion people on Disney Plus. I mean, maybe we are, but I just don't see that happening. Um, so maybe we drop this down to 30%, maybe even more, 25%. Yeah, and then you get 500 million people on the platform by the end there. That seems maybe possible. Okay, so I feel okay with these numbers. Um, so we'll kind of leave that as is. And then, oh, I don't know what that is. We can delete that row. There we go. And now we can take this total revenue number, we can link it back up into here for the direct to consumer. So in what we'll notice here in 2019, 9 billion, and then where's the 6 billion here, and then this is 13.4 versus 17. So there's about 3 billion of this international. So we're going to take whatever our number is and just add 3 billion to it for the international aspect. So we'll just assume that that stays flat. So there we go. Is that correct? Let's see. Yep. Okay. So we have that. Calculate some growth rates here now for whatever this turns out to be in total. So 5, 13, 7, so, probably semi-reasonable. Obviously, we see this weird spike in 2024. That's just because we're plugging to the 350 million estimate they gave us. You could probably change how this gets there, but ultimately, you're getting to the same spot. And then for these other businesses, for now, parks and entertainment, I honestly think it's going to jump back to the 26 once the world's back open. So we'll calculate the growth rate for this one. And then we'll go back to a more normalized growth rate of like 5%, which is what we've been seeing historically. So once we have that, we can link this all up and kind of see where we end up at now from that aspect. And the reason we're assuming this goes back is COVID truly did impact the parks, right? They were closed, they couldn't operate them. So we're gonna give them credit there. Those are gonna come back. Studio entertainment, right? This is gonna be like movies and things of that nature, right? That's down without theatrical releases. So honestly, I think that this will go back to where it was pre-pandemic, just because there's a big pent-up demand. So similar to this one, we'll calculate that, and then I'd say let's just do this kind of at like a 7%, and we'll see how that kind of turns out. My thought here is like they have Marvel, they have Star Wars, they still create original content. I think that from that standpoint, I don't think Disney is going anywhere from their studio abilities to churn out hits. I think as long as Disney produces movies, people will go see them, assuming theaters are back open or they figure out their direct-to-consumer model. Um, And then the last one is media networks. So, I mean, this has just been growing 13, 14%. I think this is like the ESPNs, the news networks, things like that. So I'm just going to do this and then subtract a 0.5% a year and have it kind of slowly regress down into a, lower single digits. So we'll do that here. And I know this is a convoluted way of kind of getting to the total growth, but I think that for something like Disney that has so many different distinct business units that were materially impacted and materially changing and growing rapidly, it's worth the time to break it out separately. To be honest, eliminations, this is something I should have spent more time on to understand it better. I'm not entirely sure what the eliminations is, but I think I'm just going to set it to the average here of 3. I think this might actually be like revenue. I don't know if it's revenue that's attributable to minority shareholders or what exactly, um, but let's see. And these are looking pretty frothy, if I'm being honest here, going from 70 billion to 85. But I guess we're really saying pre-pandemic, right? You get your 10 billion back from here, from parks and experience. Everything else grows a little. Um, yeah, I mean, I think it seems crazy at first glance, but with the 10 billion reduction here in parks and experience, if that truly can just come back, which I think it will, um, and then your direct to consumer is just so much bigger, you know what I mean, doubled in a year, and we're expecting it to just continue. I think that this is probably fair, maybe a little aggressive, but I think it's fair. So, and then now we just need to calculate the total growth rate, and this will link back to our main page here, which is what we'll use to kind of finish out our DCF. So, right, the first year looks crazy because we have the rebound in Parks and Rec, um, or Parks and Experience, not not Parks and Rec, and then just the total growth rate just kind of, you know, low double digits and just kind of regresses down. So let's hop back over here. Let's see how things are starting to look. So the big thing here is COGS, right? So COGS historically 50 to 60%, creeped up to 67 this year, just with um, the parks are pretty fixed costs, more or less, I would argue, in comparison to some of these other things. So um, I would say we're probably going to end up in probably like a 62, 63% range because I think the direct to consumer is definitely lower margin. But over time, right, with scale and whatnot, it becomes better margin because I think a lot of it's like a high fixed cost basis. So I think I'm going to set this to 60, then have it grow, I don't know, like a 1/4% until we get into kind of like the 63 range. And then we'll just kind of assume that, and maybe, oops, maybe a 1/4% isn't even high enough. I guess we hit 63 at the end there. So that's fine. SG&A, for now, we're just going to hold that flat. My thought here is like SG&A stays flat as a percent of revenue. As revenue grows, SG&A increases. So it kind of makes sense. Other expense, we can ignore this. This is in some of the other models. They lump it all into SG&A. Tax rate, this may actually change. There's talk in the Biden administration to increase the federal tax rate back to like 28% or something, or up to 28% from 21. But for now, we'll leave it. CapEx 876. This actually may need to go up. My guess is they didn't have as much CapEx this year, just due to, oh, I wanted that to be a 1/4%, just due to the parks being closed. There probably wasn't as much maintenance CapEx and whatnot that needed to happen, and then we'll kind of just set it to 8% there. Depreciation, I always kind of hold that constant. At 80%, that means there's growth CapEx on top of your regular CapEx every year. The last thing we need to do is networking capital turns. So this year was definitely a little bit funky, just because of the kind of, I'm not sure. We could look at the balance sheet, what dropped in their current assets. So for networking capital, it's really receivables, inventory, and then I included television costs. Um, I might have included other as well. Sometimes I do that. Let's see, E8, yep, and other. So the way to think of current assets is it's things that are a use of cash in the sense that like you're putting cash out, and not collecting it or not keeping it. So it's a use of your cash sources. So you don't include cash and cash equivalents there, but like receivables, right? This is like letting someone pay you later. So the cash is out there. They haven't paid you back yet, or they haven't paid, you know what I mean? They haven't actually wrote the check for you, but you've recognized the revenue. So it's kind of like you don't actually have the cash flow coming in. Inventory, same thing. You have money tied up in inventory. Television costs and advances, my guess these are just like prepaids. And then other current assets, I usually just consider this prepaids as well. And then for liabilities, but I guess if we look real quick, it looks like television costs dropped, receivables dropped. So those are kind of the main drivers. So that's probably just a kind of a one-off, but it also looks like they had a spike in 19 for television costs and a spike in receivables in 19. And then for liabilities, this is going to be source of cash. So accounts payable, that's like money we owe people. So if we haven't paid them, that's good for us. We're retaining the cash for longer. The idea here is over time, your payable terms are longer and your receivable terms are shorter, so you're receiving cash quicker than you have to pay your suppliers. And you can do that when you're a large company. And then outside of this, debt isn't included, and neither is deferred revenue. Because revenue that's deferred, they've either received the cash or haven't. But we can't distinguish that from here. A lot of times it's they've been paid, they just can't recognize the revenue yet because they have to do something else. So um, but I think we hold this back to kind of the average here of 16.3 if we exclude 2019. Looks a little funky. And, you know, in the first year, this is going to cause a pretty crazy, you know, impact to cash flow. But outside of that, so we'll do that. I would say Disney's a pretty safe company. You know, 7 to 8% is probably reasonable, maybe 8% because of their high debt load. And, you know, based off this first pass, right, you get a valuation of 150 billion to 221 billion, just depending on how you sensitize it. And if we go back here, they're currently trading at a $336 billion valuation. So the first thing I would think that we could kind of do is maybe people are, and by people I mean investors, are assuming that they can get back to these 55% margins. Um, you know, and maybe that's true. So we could kind of come here and instead of increasing, we could decrease a 0.5% a year, right? And if you know if we really can over time scale back towards these 55% COGS, right? Now you're at a $300 billion valuation, and depending on how you sensitize it, 260 to 370. And that's fair. I haven't done a whole analysis on their COGS to understand the different business lines, but right, the parks aren't going to get more expensive just because you raise the ticket price. It'll become more profitable, which is what they do. And then the streaming, right? There's a ton of initial costs, but once you have the people on the platform, right, those costs don't accelerate for every user. So, maybe it is realistic they can get back. And if that's the case, right, now we're saying they're probably fairly valued at 330 billion. And if you think they can win the streaming wars, right, I think that that's another big driver here, right? You could say, hey, you guys are going to win the streaming wars, and I actually think, you having a billion people on Disney Plus actually isn't insane. So you guys are going to go, right, much higher growth, and you're going to get up to 960, million users, and then now all of a sudden, right, 280 to 410. So I think the story of Disney is really your conviction on them to win the streaming wars and their parks business to bounce back and everything else to just kind of stay the same. If you believe in that and you think that they're going to be the streaming provider of the future that every family signs up for, probably not hard to get behind it. But I mean, what's the world population, like 6 or 7 billion? Seven, okay, 8 billion people. So 1/8 of the world having Disney Plus. I don't know. How many users does Facebook have? 3 billion. So maybe having a billion users isn't as crazy as it sounds. Um, could be possible. The other alternative is if, say, we don't think they can get to a billion and it's only going to be 500 million, but we think as they scale, they can, slowly increase the price. And instead of, the average 442, this is going to go up to, they're going to increase it by, I don't know, 25 cents a year. Let's see how that impacts everything, right? So, I mean, obviously that's going to impact the revenue because now it's $6 times this, um, which gets you 40 billion in revenue. So if we kind of assume that, right, then you're back at 270 to 391, 3% with an 8% discount gets you $308 billion valuation. They're kind of right there right now. So, it might not even be you have to win the streaming war. It's just over time, more people sign up for streaming, cut the cord. Disney has a great offering. You have half the market in streaming. Um, and going from 32 million to 350 million subscribers in 2024, like they're projecting, is tenfold increase. And then to not even double that in the next, what is it, 6 years? That's probably reasonable. And then if you can just assume they can have a little bit of pricing pressure here, um, yeah, I mean, I think this is one of the first companies I've looked at where um, they're probably in a pretty fair valuation zone right now, assuming they can bounce back from COVID. And I think what's really fascinating is if you look at their stock over, I mean, even the last year, right? Let's go 5 years. Pre-COVID, right, 150. And this is back right when they launched Disney Plus, before we really knew Disney Plus was going to be a contender and have 100 million users, right? So if you don't have right at COVID at 96 a share, that was probably a really good deal if you got into it. And then, right, it's slowly been shooting back up as they've been releasing. I think October is when one of those times is when they released how many subscribers they had. Um, and then March of this year, right, they've announced they're already at 100 million on Disney Plus, aiming for 350 million total subscribers to their paid services by 2024. It's crazy. So I think they're actually probably relatively fairly valued. And if we look at like a Netflix, who's just right, just the TV aspect, um, their market cap is two-thirds the size of Disney. So Disney has a lot more than just the subscribers too. They have just a legacy of content and trademarks and characters, and then theme parks. Right, it's a whole entertainment experience, not just a streaming platform. So um, definitely think it's an interesting company to look at, and feel free to download the model and tweak my assumptions. And if you have anything you want to highlight or call out, put it in the comments. And it's always fun to go back and kind of adjust accordingly. So thanks for tuning in, and yeah, look forward to more videos to come. If there's any companies you want to see, feel free to comment below, and I'll look into them and see if I can't pull something together. Um, yeah, take care.